Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
We are focusing today on OPAD Solutions, Inc., OPAD, really a fascinating study in distressed equity and financial microstructure. In early Q1 2026, this stock is trading, consistently in this highly compressed range of about $1.20 to $1.50. This pricing, it implies the market has assigned just a very high probability of total failure.
And yet, if you look beyond that distressed pricing, the analyst consensus price target sits significantly higher, closer to $2.26, which suggests that if the company merely survives, there's over 60% upside baked right in. The immediate behavior of this equity is being driven, I think we can agree, entirely by market microstructure. That's why we're even having this discussion.
Exactly. The technical setup is, it's extreme. Short interest has been spiking toward 29.2% of the true free float, and that days to cover, or DTC ratio, is approaching 4.83 days. That is not just high, it's dangerously coiled. And that setup frames our central question. Can OPAD's aggressive strategic pivot, this deliberate shift to an asset-light model, and this coiled technical setup overcome its critical liquidity constraints and justify a massive valuation re-rating? Or does the distressed price accurately reflect an imminent solvency risk?
And I maintain that solvency risk is the ultimate gravity well here. Technical anomalies, no matter how extreme they seem, they are completely irrelevant if the company runs out of cash in the next 3 quarters. The high probability of insolvency, which is driven by persistent cash burn and frankly razor-thin liquidity, absolutely justifies the stock's current valuation.
See, I hold the opposite view. The multi-bagger recovery scenario is, in my opinion, far more likely. The market is profoundly mispricing the survival risk because the dominant bear thesis is, it's backward-looking. It focuses on the capital-intensive inventory metrics that management under CEO Bear is deliberately and rapidly dismantling. And critically, the technical risk for short sellers is extreme. We have short interest approaching 30% of the effective float, and the cost to borrow is high, around 12% annualized. This is a maximally crowded trade. It's structured for violent upward repricing, a classic short squeeze upon any positive catalyst.
A squeeze is a momentum play. It is not a sustainable thesis. Solvency is the fundamental existential threat. Let's look at the cash reality as of Q3 2025. They had only $31 million in unrestricted cash. Meanwhile, the company is maintaining a quarterly adjusted EBITDA loss of roughly $4.6 million. That liquidity math gives them optimistically maybe 7 to 8 quarters of runway before hitting zero. And that's assuming the burn rate doesn't accelerate. The generalist bear thesis, it just remains sound. Inventory impairment risk persists on the balance sheet, and skeptics rightly believe the company will run out of unrestricted cash before they achieve the necessary scale to self-fund operations.
But that ignores the fundamental pivot, the successful transition to asset-light services, like their Renovate and Direct Plus offerings, fundamentally changes their risk profile because they carry zero inventory exposure. That alone warrants a significant multiple re-rating toward a technology service business valuation, not, a distressed real estate trader. Furthermore, you just can't simply dismiss the signal of insider buying. When CEO Bayer puts $227,000 of his own capital into the stock at these levels, that actively contradicts the bankruptcy narrative you are painting. It suggests a deep managerial confidence in survival.
I think we need to put that insider purchase in perspective, though. $227,000 it's symbolic. It is excellent PR. It signals management confidence. I'll give you that. But when the company is losing $4.6 million every 90 days, that capital injection is not material. It doesn't solve the core liquidity issue. You are focusing on a positive sentiment indicator while ignoring the concrete threat, the high debt-to-equity ratio, which is over 390%. Generalist investors are rightfully spooked by that metric because it raises the possibility of, potential technical breaches on their warehouse lines, regardless of how asset-backed they are.
Okay, let's focus squarely on that extreme pressure cooker dynamic in the near-term price action then. The 4.83 days to cover ratio isn't just a number. It implies that short sellers cannot exit their positions quickly without causing a parabolic price movement. If any significant positive news drops, a strong quarterly update, a successful debt refinancing, or even just some momentum buying, it would take nearly a full trading week of average volume for the bears to cover their positions. The result is a guaranteed short squeeze, a vertical move.
I acknowledge the mechanical volatility of that ratio. It is a crowded short. But institutional capital does not base long-term positioning on microstructure alone. We have to examine the cost of delay for the company itself versus the short seller. The 12% annualized borrow fee puts pressure on the shorts, yes, but the $4.6 million quarterly EBITDA loss is a relentless, continuous drain that shortens the company's liquidity runway every single day. The company is fighting a clock, not a price target. Remember that $21 million capital raise in July 2025? That was highly dilutive, confirming the ongoing, desperate need for financing. A technical squeeze only creates a temporary price jump, which then makes the next inevitable dilutive capital raise slightly less painful for the company, sure, but it doesn't solve the fundamental problem of needing to access capital constantly.
I think you're missing the forest for the trees when you focus only on the mechanics of dilution. Management is trying to engineer a scenario where that next dilutive capital raise is not inevitable. They are doing that by rapidly executing the asset-like pivot. This brings us to contention 2, the efficacy and timing of that pivot. Q3 2025 revenue declined sharply to $133 million. You cite that as a structural concern, but it was not a collapse in market interest. It was an intentional, deliberate defense strategy.
Explain that. Revenue contracting that sharply usually signals a problem with the core product or demand.
It signals successful risk management. They intentionally tightened the buy box. For listeners less familiar with iBuying jargon, tightening the buy box means the company became far more selective about which homes it was willing to purchase and hold in inventory. They are focusing only on the highest quality, lowest risk inventory that guarantees a quicker, safer turn and preserves cash. They chose preservation over volume, which is exactly what a company facing liquidity constraints should do.
I see the defensive rationale, but the effect is still a contraction in the main revenue stream. And while they point to success in their service revenue, the Renovate arm generated a record, what was it, $6.4 million in Q 2025? That figure is marginal. I mean, $6.4 million in a quarter is a fraction of the necessary multi-billion-dollar run rate required to justify a tech multiple, and, more importantly, to offset the persistent G&A losses tied to running a massive operational platform.
But that stability in unit economics proves the model isn't fundamentally broken on a per-unit basis. Despite the volume drop, they maintained gross margins between 7 and 8.9% throughout mid to late 2025. This shows they can still turn a home for a profit, which is something their rivals struggled with severely during the inventory clearouts. The service revenue, while small now, is crucial because it is purely service revenue, carrying zero inventory risk and generating a much stickier, higher quality cash flow stream.
But scale matters, especially if you want that tech valuation. The market currently values OPAD like a distressed retailer, with a market cap of only about $35 million, because it assigns zero material value to the service arm until it achieves significant scale. They're being judged on their iBuying activities, not their side hustle. And we have to revisit the fundamental structural risk of iBuying itself, the lesson of Zillow's spectacular failure.
You're referring to adverse selection?
Precisely. Adverse selection is structurally inherent in algorithmic purchasing. It means that sellers who can get a fantastic price on the open market generally choose to use an agent. The sellers who use iBuyers are often those who need speed, convenience, or whose homes have hidden flaws the algorithms miss. OPA has layered in a human in the loop to mitigate this, but until the service revenue can truly cover their entire G&A overhead, not just a fraction of it, the stock remains deeply speculative, because that adverse selection risk is always lurking in the background of their trading operations.
Well, I think the operational data strongly suggest OPAD has learned from those Zillow mistakes and implemented superior risk management. This brings us to contention 3, agility and credit market confidence. Compare OPAD's inventory health against Opendoor, their main rival. OPAD has a leaner inventory, holding about 498 homes versus Open Door's very heavy inventory of over 3,000 homes. More importantly, OPAD's turn rate is remarkably fast, 11 days to pending versus Open Door's sluggish 29 days.
That 11-day turn rate is undeniably a competitive edge. I concede that. This agility, what you call Bear's operational DNA, it saved them from the disastrous, massive legacy inventory clearouts that plagued larger rivals in 2024. They are leaner and smarter.
And that operational excellence is precisely why the credit markets have maintained their total liquidity facilities, keeping them over $75 million. The continued willingness of sophisticated financial lenders to extend and maintain those facilities is the ultimate vote of confidence that the core inventory, those 498 homes, is not toxic. If the lenders believed bankruptcy was imminent, they would be pulling those lines immediately.
I think we need to clarify what that confidence really means to the lenders. While the maintenance of credit lines is a positive operational signal, it does not translate directly into confidence in the equity. These warehouse lines are non-recourse debt, secured by specific underlying real estate assets. If OPAD goes bankrupt, the lenders simply take possession of the homes, securing the debt. The debt structure is designed to protect the lender first, regardless of the fate of OPAD's equity shareholders. It is not an endorsement of the stock price or the solvency of the corporate entity itself.
But if the inventory was of poor quality, the lenders would still reduce their exposure, because liquidating those assets during a bankruptcy process is costly and slow. Their maintenance of the $75 million facilities suggests they are comfortable with the current assets, which, to me, undermines the Bear's argument about imminent impairment risk.
Let's consider the macroeconomic constraint, though. Even with the perfect 498 homes, OPAD is fighting the lock-in inventory floor caused by high interest rates. Homeowners with 3% mortgages are not moving. This keeps existing asset prices sticky, which is good for the value of OPAD's inventory, but it severely depresses transaction volume across the entire market. And OPAD's service pivot and its core trading arm are leveraged to transaction velocity. Low volume fundamentally hurts their top line and extends the time required for their service revenue to scale.
The operational changes mean they are positioned to capture market share when volume returns, and more critically, they have demonstrated the capability to survive the current drought. The combination of management confidence, which is the insider buying, structural protection from the asset-light pivot, and the immediate quantifiable pressure on short sellers suggests that the $1.20 price is a gross undervaluation of that survival premium.
And I think you are underestimating the fragility of the liquidity runway. While credit line extensions are positive, any sudden, unforeseen shift in housing sentiment, even a small dip in home prices, or a technical breach of a minor covenant related to the value of those 498 homes, could trigger a liquidity spiral, irrespective of management's intent.
Ultimately, the investment thesis here is fundamentally asymmetric, which is what attracts the volatility arbitrage funds. The downside risk is, of course, clearly capped at 100%, a total loss of equity. That downside is offset by the potential multi-bagger upside, which could be 300 to 500% if a squeeze occurs and the company successfully re-rates toward a tech service multiple. The risk is undeniably high, but the potential reward suggests the stock is currently mispriced relative to the deep operational and strategic changes management has implemented.
And I am simply not convinced that the operational changes solve the primary constraint. The core of the bear thesis, insufficient unrestricted capital to cover the $4.6 million quarterly burn rate, remains the driving force behind this depressed valuation. We readily concede the technical setup is volatile, but the binary outcome, which is insolvency or recovery, requires a strict, relentless focus on the cash flow reality, which is not yet solved. The liquidity cushion is simply too thin to justify a massive re-rating based on promises of future service scale.
So the listener is left with a choice, determining which factor is more immediately critical. Is it the systemic risk reduction offered by the strategic pivot and the convincing insider actions suggesting a path to self-sufficiency? Or is it the immediate, pressing risk presented by that razor-thin $31 million cash buffer and the persistent negative cash flow?
Both sides of this distressed value arbitrage play rest on strong, evidence-based arguments drawn directly from the financial microstructure and the operational results. The question really is whether you bet on the technical pressure or the fundamental time bomb.
A critical consideration for every investor looking at this unique situation in OPAD.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.